Day 17, Factor Investing, a Dash of Spice. Our journey has been built on the principle of owning the entire market through a simple, market cap weighted index fund. But what if we could slightly tilt our portfolio based on persistent academic insights? Today, we briefly explore the advanced world of factor investing, not as a core strategy, but as an optional dash of spice for the sophisticated palate. The foundational work of economists Eugene Fama and Kenneth French identified that, over the long term and across many markets, certain types of stocks have tended to deliver higher returns than the market average. These characteristics, or factors, are not guarantees, but they are persistent patterns in the data. The two most well-researched factors are value and size. The value factors suggest that companies that are cheap relative to their fundamental worth measured by metrics like price to book or price to earnings tend to outperform more expensive glamour stocks over the long run. The theory is that the market overlooks these unfashionable companies, creating a bargain that is eventually recognized. The size factor posits that smaller companies with more room for growth and less analyst coverage have historically delivered higher returns than their larger, more stable counterparts, though with higher volatility. Other factors include profitability, companies with high-quality earnings, and momentum stocks that have been performing well recently tend to continue for a short period. So, should you abandon the total market index for a factor-tilted portfolio? For the vast majority of investors, the answer is a resounding no. Factor investing is complex. Factors can underperform the broad market for a decade or more, testing the deepest levels of an investor's conviction. It requires a sophisticated understanding and the discipline to stick with a strategy during long periods of disappointment. However, for the investor who has fully mastered the core principles, has a very long time horizon, and possesses unshakable discipline, a small, deliberate tilt toward these factors can be a considered choice. It is not about beating the market every year. It is about structuring a portfolio that targets different sources of return, potentially increasing diversification at the source. Think of it this way: your core global index fund is a nourishing, balanced meal. Factor tilts are like a potent spice. A tiny amount might enhance the flavor for a discerning palate, but too much will ruin the dish, and it is entirely unnecessary for survival and health. The simplicity of a single, total market fund remains the gold standard. But for those who understand the risks and have the fortitude, factor investing represents an academic-based, systematic way to potentially enhance returns. A dash of spice, but never the main course. Tomorrow, we return to our core principle with a powerful reminder: keep it simple. Thank you.